Andy, I've actually never had the chance to interview you before, so unfortunately, I'm going to have to limit myself to the very best ones. But before we talk about Wealthfront and we talk about self-driving money, I have always wanted to ask you one question that I have not been able to find anyone else who has asked you, and that is this. As you well know, your career has almost taken the exact opposite approach as to the traditional trajectory that entrepreneurs like you follow, in that you were a venture capitalist first, a very successful one, and then from there you decided you were going to roll up your sleeves and build a company. And so my first question, just to sort of lead things off, is what do you know about running Wealthfront that you wouldn't have known if you had gone the more traditional route?
I think that the one thing that I brought with me from venture capital to running a business, and I don't think the two are related in any way, shape, or form, but the one thing that I brought with me is a belief in what's known in baseball as slugging percentage versus batting average. So in almost everything in life, we are judged by the percentage of the time that we succeed. You can think about it as kids in grade school and high school. You can think about it in almost every endeavor. We evaluate ourselves based on the percentage of time that we are correct. In venture capital, someone who is correct most of the time is actually a very poor investor, because in venture capital, the magnitude of success matters far more than the percentage of time you are successful. And the more often you're successful, that means you're taking less risk. Less risk usually means less upside. So one of the things that I really preach to our team is I don't care about the percentage of the time that we're correct. I care about the magnitude of success when we are. And I encourage people to take risk, that I want them to fail. I know that sounds really strange, but if we don't fail, we're not taking enough risk. And the way that we should measure ourselves is the magnitude of the success when we do succeed.
So when you say that they're not related, that's a very interesting comment, because, I mean, you know, the typical career path, right? You know, a entrepreneur has a successful exit. He or she decides they, you know, don't want to start another company from scratch, and so they become a venture investor. Do you think that we would be well served if more people took the route that you have taken?
No. What I did was completely accidental and something that I never intended to do. I think that there is a very common misperception that venture capital firms prefer to hire people with operating backgrounds for their operating backgrounds. Now, venture capital firms clearly do prefer to hire people with operating backgrounds. But what I don't think that most people realize is I think the key to success in venture capital is the quality of your network. All things being equal, if you fish in a better pond than I do, you're going to make more successful investments, even if I'm more talented. And if I was very successful in an operating role, then the odds are that I was heavily recruited, which, by the way, is a proxy for network. And I was probably also heavily pursued for my advice and counsel, because that's what people do with successful people. And that too is a proxy for network. So if you have a tremendous network, you can have sort of average judgment. If you're in a good firm, you're going to make really good investments. The last thing that you want to do is actually use your operating experience, because then you're imposing your will on the management team, which is the worst thing that you can possibly do. But I think a lot of people think that venture firms hire people out of operating backgrounds for their operating experience. And in my experience, that is absolutely not the case. As a matter of fact, there are very few founders that have succeeded as venture capitalists. There are many operating executives who have succeeded as venture capitalists, but there are very few founders who, because it's such a different mentality.
Okay, well, let's talk about the company that you have founded. And I'm sure most everybody is familiar with Wealthfront, if not already a customer. But just to level set it, if you could just give a very brief description about what Wealthfront is today and the concept of self-driving money, which is clearly one that is very important to the company and where it's going.
Sure. Well, we now call ourselves a next generation banking service that helps young professionals manage their savings. We do this by providing high interest checking and very low cost investment management services, all delivered through a 5-star rated app. Our vision for the future is to automate all of your finances. And we affectionately refer to this as self-driving money. And by that, what we mean is that you are now actually able to direct deposit your paycheck with us. We'll pay your bills, and then we'll route the remaining money to the most appropriate account or to pay off your debt, depending on your particular situation or goals.
So was this always in the roadmap, or is Wealthfront's evolution into seeking to become the core banking partner for your customers something that happened as a result of your experiences in the market, competitive pressures, where you saw the opportunity, et cetera, et cetera?
The honest answer is it's a result of our experiences. And I think whatever anybody tells you otherwise, they're full of it. So I'm a pretty candid and transparent guy, and it really is a result of our experiences. You know, we started with an investment management service, and we grew quite nicely. And we started adding more and more capabilities to what we do. And what we came to find was that the primary areas in which we added value technically were in automation and in advice optimization, that we had made very significant investments in those two areas. Well, one day, one of our product managers had asked me what our vision for the future was. And as someone who likes to teach, I've been doing it for 15 years at Stanford Graduate School of Business, I really try to focus on simplifying the message and getting it down to something as pithy as possible. And I couldn't give him our vision in one sentence, which frustrated me. So I went off and thought about it for a little while and came back with our vision was to automate and optimize all of your finances. And then one of our engineers, when he heard that, reduced it further to self-driving money. So that became the vision over time. In order to deliver on that vision, we needed a repository for your paycheck. And so that's why we needed to deliver a cash account that had checking and savings features to it. And so it all evolved naturally to deliver on that vision that leveraged our strength and our advantage.
So would it be fair to say then that whereas you used to be lumped into the same category as Betterment and Personal Capital and all those entities, now your core competitor set are banks who somehow, some way want to try and figure out how to capture younger people into their world rather than in Wealthfront's world?
Well, number one, I prefer to say we created that category.
Okay.
But yes, we now consider our primary competitors to be the big four banks, you know, Chase, Citibank, B of A, and Wells Fargo, because that's where young professionals keep the vast majority of their money. You know, we're focused on people who are 25 to 40, that's the millennial generation. And what we find is, I think Deloitte has done a study that found that collectively millennials have 4 trillion of assets today. In the next 10 years, that should grow to about 12 trillion, not through inheritance, but because they're in the wealth accumulation phase of their careers at 25 to 40. And so if the millennial market is like any other market, there's an 80-20 to it. And so we think 20% of the millennials will generate 80% of the wealth. So we think that the millennials who save will represent on the order of 10 trillion of assets. Our challenge is to deliver services that ideally serve those millennials who save.
Now, you have talked a lot about Wealthfront's goal of always creating delightful software that creates a huge amount of value for your customers and helps facilitate the automated future that you talk about a lot. One question I have on that front, and maybe it's because I'm over 40 now and life gets more complicated as you do, but as your target market gets wealthier and their financial situation gets more complex, sort of more money, more problems. How do you think about the ability of software to be able to keep pace with the added flexibility or added complexity that many people will have over time?
Well, if you look at what we delivered when we started in December of 2011 and compare that to what we have today, there's literally no comparison. So software actually advances at a much faster rate than people can absorb it. That was one of the critical insights that Clay Christensen had with disruption theory. But when we started, we offered a diversified and rebalanced portfolio of low-cost index funds. And I used to infuriate my colleagues at Wealthfront by saying we add very little value and price accordingly because we charged a really low fee. And over time, we added more and more capabilities. We kept it really simple, but on a net of fee after tax basis, even the most sophisticated private wealth manager can't come close to delivering something as capable as we can, number one. Number two, if you think about how we optimize what you do, our average client links something on the order of 3.5 financial accounts to us. So they might link a bank account, a brokerage account, their mortgage, and maybe some other accounts. As we ingest more information from you, we actually understand you far better than any financial advisor could. And it doesn't take that fancy software to figure out what's in your best interest. It's not artificial intelligence, it's just optimization. So we think that what we do today is radically better than what we did even a couple of years ago. And when I think about what we're going to be able to do in 2 or 3 years, it's just incredible.
Okay, I got to take one more run at this, in part because I'm in the middle of dealing with a major credit card issuing bank on a fraud matter that just will not go away. And I have spent hours on the phone dealing with the bank and all of the well-intended customer representatives trying to deal with it. And so on one hand, I think to myself, they're not giving me a whole ton of value. But on the other hand, I think to myself, it's sure nice to be able to reach out to a human being and at least explain the situation from a fraud perspective. What's your view on things like that come up where it might be hard to have a piece of software prepared to deal with somebody who's confronted with fraud?
That's a superb question and a huge misunderstanding about what we do. So one of my favorite lines to describe our customer base is something that we've heard over and over again, that we pay you not to talk to us. So we want to create software that enables them never to have to talk to us. Just because they never have to doesn't mean that we don't make it possible for them to talk to us. Now, just like we've taken a very different approach with our product, we've taken a very, very different approach with support that we actually described in a blog post recently that quite a bit of interest. So our support people are known as product specialists, and they are actually more licensed and capable than anything you would find at any bank or investment firm. They're licensed financial advisors. Some of them have CPAs, some of them have CFAs, chartered financial analysts. They're incredibly capable, but they're not there to provide advice. Because one of the things that we've learned is our clients don't want advice. People actually want it done for them. And so they're there if you want them, but we define half of their job as trying to figure out what is it in the product that is causing people to reach out to them that if we fixed would avoid someone ever having to contact us. And so every year, one of the things we pride ourselves on is every year our product specialists are able to support 60% more customers. And that's only because half of their job is support and half of their job is figuring out how to work themselves out of a job. And so if you call us, you get typically our clients email, but if you were to call us, you would get a rep in 10 seconds.
Really?
Yeah, in 10 seconds.
Amazing.
And no voicemail tree or anything like that. You would get one of our reps in 10 seconds. Now, during COVID, when the branches closed, when I tried to reach out to Wells Fargo to discuss closing a bank account, the message said I had to wait for 3 hours. So we offer radically better support in addition to radically better software. It's just that that's counterintuitive. So most people think that we don't.
Gotcha. Well, so you mentioned COVID. You are no doubt aware of the fact that this pandemic has created a huge rift between companies that have seen their growth get accelerated as a result of it and companies that have fallen behind. I think I know how you're going to answer this question, but I'll ask it to you anyway. How has Wealthfront managed during this period?
Well, we've continued our growth. We have not benefited from the growth of day trading. So I think that this environment has caused an explosion in self-directed trading. We have not benefited from that. We're boring investing. Over our 8.5 years, the compounded return, pre-tax return for our average client is approximately 8%. That's not very exciting, but I'll bet you that's better than 95% of Americans. So we're the boring, really good way to invest. And right now and fortunately that continues to grow, but it is not benefiting from the explosion that day trading is right now.
Well, you're cutting me off at the pass there because, you obviously knew what my next question was. I'll still ask it anyway. Obviously, there is one firm out there that has received an enormous amount of attention and has perhaps opened up the notion of investing to a whole contingency of younger investors and savers who, perhaps never had an investment account before. The reduction of fees to zero, of course, has certainly paved the way for people to get involved in trading and the like. Is it a problem, nevertheless, that you have another entity out there gunning for younger folks that just generates so much attention and is constantly being covered in the press and the like?
I wouldn't characterize it as a problem. Every 15 years or so, there is a day trading craze. And people have to learn that it doesn't make any sense. The research is really, really clear. 90% or 95% of professional investment managers don't outperform the market. What makes you as an individual amateur investor think that you're going to do it? So actually what we find is that they bring more people into investing. They're going to learn that they're not able to do it themselves. And then ultimately they're going to realize that the research is really clear and that our approach is the better way to go. So we think of it as a farm system for us. We're the tortoise and they're the hare. I think that they've been an amazing business. Part of it is entertainment. I think it's a shame the amount of money that people lose doing that. But I think they've built just a tremendous business, and I really respect them for that.
So you don't worry about active management making sort of a wholesale comeback and people thinking, oh, the right way to go is for me to, read Barron's on the weekend and go out and pick stocks and the like?
History may not repeat itself, but it sure does rhyme. And I'm old enough that I've seen this happen a number of times. And the same thing happens over and over and over again. One of the things I think that confuses people is that the S&P 500 is up, 50 or 60% from the bottom. So it's about even now with the peak of the year, but it's up 50 or 60% from the bottom. So if you started investing in late March or in April or in May, and you're up 25 or 30%, you think you're brilliant. And in fact, you suck. Because if you had bought an index fund, you would have been far better off. But, compared to any historical time, if you were up 25 or 30% investing on your own, you would think you really knew what you were doing. And, that washes out and people learn their lesson. But this is exactly what's happened in the past. Day trading has worked and been really popular in other environments where there has been a sudden and very large increase that has led people to think they're doing well because they don't understand relative performance. They just understand absolute performance. And it always ends the same way. And the research is really clear as to why that happens.
So on the note of research, you may have seen that, and there have been any number of studies on this. Younger generations are facing perhaps a daunting challenge to get out from under student loan debt, and some of the other challenges that previous generations haven't had. In the pantheon of things that sort of keep you up at night, are you at all concerned by the fact that, again, by some studies, the millennial generation is sort of the first generation in a long time, if ever, that may not ultimately do better than their previous generations? Because you want your customers to get wealthy, right?
Right, but remember what I said before about who we target. I said that we focus on millennials who save. And that the millennial generation, I think, is the largest generation in the history of the United States. There are about 90 million of them. And I think 20% of them represent 80% of the assets. So for the people that we're focused on, they're doing quite well. There are many millennials, we think on the order of 20 million, who are not smoking weed in their parents' basements all day long. that they're actually doing exceptionally well in their career and growing and saving money. So we're not trying to serve everyone. We're narrowly focused on a very large niche.
You say smoking weed in the basement like it's a bad thing, Andy, so maybe.
No, that's the narrative. I'm just repeating the narrative that people want to negatively paint millennials, which I think is terribly unfair.
Understood. Okay, well, look, you have a number of questions coming in here that I'm going to turn to in a moment, but I just have one more question for you, which is a little bit farther afield than some of the others, but I have to ask it to you nonetheless. Your perception of an automated future for Wealthfront and for your customers is great insofar as your company is concerned. Do people ever approach you and say, what do you think about what that means writ large across the economy, and how do you feel about universal basic income and things like that? Because, you want to lead with software, and for you, software really can heal a lot of problems that we humans are not able to do on our own. So what's your take on that?
What specifically are you getting at, Greg? I'm not quite sure.
What I'm getting at is the idea that we're going to have a structural shortage of jobs, sort of the Andrew Yang approach, where we're saying software is going to take away a lot of the jobs, and we need to have alternative ways for people to earn a living and the like as a result of that.
That is absolutely true, and something my wife and I have talked about actually since the late 90s. That I think that is a very serious issue, and universal income actually is a fascinating way to bridge us. And I know that's a polarizing point of view. That doesn't mean that I was a supporter of Andrew Yang, but I think that the idea of a minimum income to people who are not going to get jobs again because of this change in the way the economy is built, it perhaps could be better for society. Because if we keep polarizing society, we could have a civil war. That's not a good thing. So the question is, should I not deliver this value to help people get access to better manage their money? I don't think that would be good. But the funny thing about our space is that a lot fewer people are going into financial advisory jobs because I think they don't believe in them. So in our little corner of the world, I don't think that we're eliminating as many jobs because young people don't want to go into it because they don't see the value of it. So we're in a strange corner of it. But yes, I think that as software eats the world, there are tremendous interim societal issues that result from it.
Great. Well, thank you for adding that honestly or responding to that honestly and candidly, as you are known to do. All right. So I'm going to ask the questions here on behalf of some of the people who've written them down here. Sheila asks if the goal of self-driving money would be the goal for self-driving money would be applied to all demographics. So why are you targeting young folks with it?
Well, because the first rule of marketing is appealing to everyone appeals to no one. So you have to figure out an audience that is most likely to accept it. Could it work for everyone? Absolutely. But let me give you a little anecdote just from this past weekend. We had some friends over in a socially distanced fashion for drinks. And one of my friends, I'm 62 years old, and my friends were the same age. And one of them came over and he said, all of our kids use Wealthfront and I use it, and I actually benchmarked it against my financial advisor. It's radically better. I'm going to move all my money to you. And I said, well, thank you. That was really nice of you. And my other friend said, I think it's a great idea, but I can't bring myself to give you my username and password for my bank to transfer the money. That captures exactly why we don't go after an older audience that could benefit from it. That they're worried about things that they don't need to be worried about. And it's better to focus on young people who actually are far less concerned with privacy.
So Daniel asks, do you foresee Wealthfront expanding horizontally into fields like insurance and lending?
Well, we actually already do lending. So we have something called a portfolio line of credit, which we think is the fastest, easiest, and cheapest way to borrow. Literally, if you have an investment account with us of at least $25,000, you're automatically enrolled in it. And if you want to borrow up to 30% of your investment account value, all you do is literally push one button and you get the cash the next day. And the current rate is something like 2.6 to 3.3%. So much lower than any rates you can borrow at anywhere else. And the people who use it are probably our most satisfied customers. So our vision is to become a financial hub where you'll buy all of your financial services from us. Our mission is to build financial systems that favor people, not institutions. And what we mean by that is if we deliver all of these services in software, we're able to lower the cost of delivering financial services and share the economics with our customers so that they always are going to get a better deal on literally every product that we offer. And if we can provide the automation through things like autopilot so that you have the peace of mind and control. One of the things people worry about is if I give in to you with this automation, I lose control. Quite the contrary. With autopilot, before we transfer money above a threshold level from your checking account to your savings or your investment account, we send you an email to make sure that you're cool with it. So we want to make sure that people have control. But we'll deliver basically every financial service, and we'll do it with better economics because we deliver it all through software.
So next question is from Hutan, who wants you to know that you're an absolute legend.
I don't know what that means, but thank you.
So no pressure on you now to answer the question really, really well. Hutan asks, as you think about innovation at Wealthfront, how do you incentivize your people to take big swings?
Well, we have a really well-defined product process, and that has reviews all along the way. And if people are not taking risk with a feature, we send them back to the drawing board. So we have a process that reinforces that. And so number one, and we have, I try to write everything down, because what I found is that we get bigger and bigger, people tend to misinterpret things. So we tend to write everything down. I'm a big believer in the Amazon philosophy. And one of the things that I wrote about in our product philosophy is something that I learned from a colleague at Stanford Graduate School of Business, a professor named Charles O'Reilly, who is well known for writing about the ambidextrous executive. And by that, what he means is that, using his language, that you have to simultaneously focus on exploitation and exploration. Actually, I taught a course on this subject. So if you hope to continue to grow and innovate, you have to make sure to allocate a certain percentage of your time on wacky new projects. Now, that's not in human nature. Human nature wants to spend all of its time optimizing what it currently has, because it's lower risk of failure. I think this is one of the reasons why hired CEOs tend not to innovate as much as founder CEOs, because they tend to be willing to explore more relative to exploit. And this is something that we discuss at great length in the company, and that we try to reinforce with our meetings.
Do you also think it's because, if an outsider is hired in as a CEO, they might be a little bit more inclined to listen to their VCs as opposed to having this clear vision, even if maybe some of the more conventional investors, don't want to hear about, wacky ideas and the like?
I actually think founders are overconfident. They think there's no way anyone would ever fire me. So they're willing to take the risks that might end up in zeros. Whereas a hired CEO is more often than not less confident and worried that if they pursue something that doesn't work in a big way, they're going to get fired. The best example of someone who actually is a hired CEO, but he acts like a founder, is Reed Hastings. He did not found Netflix. But what he did in 2011, to me, is just amazing. You might recall that Netflix tried to separate the DVD business from the streaming business because he wanted to put all of the attention on the streaming business, because he thought that had the opportunity to be much, much larger. Now, the way they did it might have had a few issues, but people reacted really poorly to it. His stock went down 85%. His board did not fire him. And now his stock is at 530. So he had the right idea, and he explained to his board, and he got their buy-in before he did it. Unfortunately, very few hired CEOs are willing to take the chance that their stock declines 85% in order to make sure that they get on the better path.